right, good evening. Welcome to the Capital Account. I am Lauren Lister here in Washington, D.C. European leaders reach a deal. U.S. stocks surge, but are U.S. banks off the hook for the Eurozone debt crisis? Well, not so fast. We'll tell you why and why Americans may have U.S. leaders to thank for their money being on the line. And could Bank of America be the first to go down 3 years after it got a bailout? And despite help from the Fed moving money around these days, could the weight of bad mortgages and sovereign debt simply prove too heavy? We'll talk to an analyst who called the fall of Bear Stearns the fall of Lehman Brothers and now has his eyes set on B of A. And the man who gave B of A $5 billion in a vote of confidence is reportedly throwing his support behind U.S. President Barack Obama. Warren Buffett, investor, is set to speak at a Chicago fundraiser for Obama tonight. As for the proposed Buffett rule, its fate is far less certain as the Congressional Debt Reduction Supercommittee remains at an impasse. But as a deadline nears, could the U.S.'s fate be a credit rating downgrade again? I don't know. Let's get to the Capital Account. All right, as I said, European leaders reached a deal in the debt crisis. It includes a voluntary haircut for 50% for private Greek bondholders, aiming to avoid, of course, a Greek default. It also includes more firepower for the Eurozone's bailout fund. Stocks after the news soared, financial stocks in the U.S. especially. So for the U.S. banks exposed to the Eurozone, does this mean they're in the clear? Safe from contagion? I don't know. Here to help us figure it out, though, is Reggie Middleton. He's an investor and analyst. He called the housing crash, he called the collapse of Bear Stearns and Lehman Brothers, and he has been harping on the crisis in the Eurozone banking system for years now, and he's had his eyes on the problems of one U.S. bank in particular in relation to it. He also writes at boombustblog.com, which is very popular, and he's here to tell us what he thinks. So thanks for being on the show, Reggie. It's nice to see you again.
Well, thank you very much. It's a pleasure seeing you as well.
All right, great. So, of course, the big news since the last time we spoke, European leaders have now come to a deal. It includes, of course, the haircut for Greek bondholders, as I mentioned, the voluntary one, whatever that means, and also an increased firepower for the Eurozone bailout fund. But the last time we talked, you said that you were expecting Lehman Brothers ×4 when it came to the European banks. After this news of this deal, do you still expect Lehman Brothers ×4 in the European banking system?
I don't see any change whatsoever. If you take a look at what has been reported to the media, you have contradictions. For instance, as you noted, the voluntary haircut. I walk up to you and you voluntarily give me 50% of all your money. Is it truly voluntary? You know, just think about it. The implications are even worse because almost all the debt had credit default swaps written against them, which is protection, contractual protection written against a third party. The European leaders are stating that this will not be a credit event that will trigger the credit default swaps. If that's the case, then the credit default swap market is a sham and there is no protection. If there is no protection, then you have lawsuits going left and right, and we all know this is a very litigious country. And on top of it, anybody who now attempts to buy these bonds in the future, since they cannot buy protection, will price the risk directly into the bonds. That means that the European leaders have just condemned their already fragile bond market by shooting rates significantly higher. And they did this simply by making a sham out of the CDS market. Last time I was on your show, I made a very simple statement. That statement still stands. There is absolutely no way out of this without debt destruction. People have to lose money because there's no capital there to support the promises that were written. The 50%, alleged 50% haircuts that are to be given to the Greek debt does not seem to be enough to bring the Greece's indebtedness to a sustainable level.
Right, and of course they were pushing for the 75% at one point. It sounded like the IMF wanted for haircuts. Now, you talked about the CDS and everything that this brings up in relations to all of these credit default swaps. But one of the things we talked about too last time was you said that one of the problems for U.S. banks is that they wrote a vast majority of the credit default swaps against European sovereign debt. So today, of course, we're seeing bank stocks for the U.S. soar. Does this mean they're in the clear now?
Well, not that I see. The ISDA, the International Swap Dealer Association, I think this is what ISDA stands for, and the Europeans, the spokespersons for the European leaders said that they don't feel this would be a credit event. I don't think any of them have any say-so in it because most of these credit default swaps are bilaterally negotiated between two private parties. I make a deal with you that says that you will pay if XYZ happens, and you make a deal with me that says you will not pay if BCD happens. We don't negotiate this with ISDA or the European leaders. We negotiate between ourselves. If there's an event, the event is governed by the contract. ISDA puts out templates, industry accepted templates, but those templates are often customized. So as to whether it be a credit event or not, I don't see where they have any specific say-so. But even if they did, litigation is going to come no matter what. If I were to purchase a bond from someone else and then purchase a credit default swap from you and pay you money for it, expecting to be made whole if there's a significant default, and there's a significant default and I'm not made whole, I have a beef with you. It's just that simple, and I end up in court.
Just that simple. You have a beef, and that litigation is the big wild card, it sounds like. I want to bring in our producer, Dimitri Kofinas, because I think he wants to ask you a question about this. Dimitri, are you here?
Yeah. Hey, Reggie. So when you're talking about litigation, two questions. One, what does that do for the CDS market itself? Do people start dumping CDS because they become effectively worthless, or do they hold on to them thinking that they can get somewhere? And also, what does that do, in your view, for the bond market, for bonds that a lot of people hold that are insured with credit default swaps? Do we see more failed auctions? Do we see selling in this market because investors can't hedge those positions, so they just sell them outright?
Yeah, well, yeah, it's a two-pronged question. The CDS market, I'm not a CDS trader, but I am very good at valuation, and there's always a common sense issue. If you pay for a contract and that contract is rendered worthless, or at least rendered mired in litigation, it is worth less than it was when you initially paid for it. So again, as I said earlier, by making a sham on the CDS market, by attempting to structure a 50% loss default without triggering an event of default, you are basically destroying the CDS market. If you destroy the CDS market and there's no way for the institutions to hedge, they will hedge in cash or simply short the bonds or request a much, much higher rate for the bonds upon purchase. In other words, price the bonds lower. What the European leaders have done, basically, is they've destroyed an already or significantly hampered an already fragile bond market. If they thought they were paying high yields before, by taking out the ability to hedge, well, you're going to pay much, much higher yields now. And the uncertainty that was there has been exacerbated and will last that much further into the future.
And Reggie, when you talk about
Hopefully I've answered the question.
I think you did a great job. When you talk about this fragile bond market and when you talk about the CDSs, when it comes to the U.S. banks, you've really had your eyes on one, and that's Bank of America. And we talked about how they moved a large portions of their derivatives books to a subsidiary that's backed by the FDIC insured deposits. So essentially putting U.S. taxpayers on the line for losses there. But my question to you is, what about Bank of America makes you so worried?
Well, Bank of America, unwisely, I don't know, maybe they voluntarily, quote unquote, as these other banks did with their 50% losses,
right,
voluntarily purchased Countrywide and Merrill Lynch at the behest of the government, again, voluntarily. But they purchased two obviously insolvent institutions that were very, very large. They were both the largest in their respective fields, or one of the largest. Countrywide, in and of itself, is a litigation sinkhole. You know, there's no reason to rehash what Countrywide has done, but in a nutshell, they have litigation up the wazoo. On top of litigation, from a fundamental perspective, they're mired in assets that are depreciating exponentially. And even if they attempt to reclaim for recovery, it's almost difficult to get a recovery. They've written bad mortgages, adjustable rate ARMs, negative amortizing mortgages on overpriced property at the top of a bubble. Okay, that is dropped. They attempt to foreclose on certain properties. In 2008, I ran a study and I found that the Bank of America, Countrywide's REO portfolio was about the same as its market cap.
Wow.
That means that if you can wipe all of its mortgage problems away, if it wasn't a mortgage company anymore, it just took every mortgage problem away, they'd still probably be borderline insolvent.
Wow.
It also means that they're essentially a distressed real estate company versus a bank. You add that on top of the depreciating mortgage assets, which is significant, throw the litigation on top of that, and then you see where where Bank of America paid less than zero for Countrywide.
And then
in other words, it was a negative purchase.
Right, and there's so much I want to get into there because this ties in with the whole mortgage market, and I want to go in more in depth. So I want to come back to you in a couple minutes if you can just hold tight. We're going to go to a break. I also want to show for our viewers' perspective because the derivatives of Bank of America tie into this, and we spoke a little bit about them and the transfer that they made. I just want to show our viewers what Bank of America's, what the holding company's derivatives are as of June, if we could bring that up, because they were $75 trillion. And you can see that when you compare that to global GDP, US GDP, EU GDP, China GDP, I mean, putting that in perspective, that is just a ton of money. So, Reggie, I want to get back to you in just 1 second if you can hold tight, and we'll be right back with you. All right, time now for Word of the Day. This is the fun part where I can break down a financial term or concept for our very smart viewer, but perhaps not the financial expert in our audience. So where is Stavros? Because he should be the bearer of good news.
Hello, Lauren.
Hi, Stavros. Nice to see you.
Nice to see you, too.
You're looking nice.
Thank you very much. So are you.
Thank you for
No
bringing
problem.
me the word. Okay, wow, this is a doozy. We should have actually saved this for Halloween if it wasn't so timely, because this is kind of a scary one. And we were talking a lot about it. It's credit default swap, as you just heard me and my guest talking about earlier. That's one reason why you should know about it. But another reason why it should be on your radar is the Financial Times reports it's been blamed by politicians for causing the Eurozone debt crisis. And now politicians are seeking to take their revenge, not just with the recent introduction of bans on some trading of credit default swaps, but also in their attempts to ensure that any haircut on Greek government bonds does not trigger a credit event, which you just heard my last guest talking all about. And I also should tell you that credit default swaps played heavily into the 2008 financial crisis with the mortgage market, which Reggie and I were also talking about. So what is the definition? It is a swap designed to transfer the credit exposure of fixed income products between parties. Okay, so that does not sound like it brings you any more clarity, but I promise I have a really simple way for you to think of it. It is insurance. And here is an example of how it worked during the housing crisis. So, okay, people bought homes. They bought a lot of them. How did they buy these homes? They took out mortgages. What did banks do? Banks took those mortgages, they bundled them up, and they sold them to investors in what's called a security. So investors bought bundles of those mortgages. Now, in case something went wrong, investors wanted to insure themselves. So what did they do? They went to a company like AIG, which everybody should know, and they took out insurance on those mortgage-backed securities, and those are credit default swaps. And of course, the rest is history. Housing, it tanked. Everyone needed their insurance to be paid on their credit default swaps. So AIG tanked and got bailed out. And there were all sorts of people buying credit default swaps when maybe they didn't even own the same amount of mortgage-backed securities in the first place. But that's a naked CDS, and that is for an entirely different day. But as we continue to talk about this more into our show, as we get back with Reggie Middleton, and as it relates to Bank of America, now you for sure know what a credit default swap is. And do not go away. Stick around right here on Capital Count. You heard Reggie talk about the mortgage giant Countrywide. Well, Bank of America is still saddled with all of those foreclosed homes rotting on their books literally, and not to mention tied up in litigation over them. When we come back, we'll talk to Reggie Middleton about what that means for B of A. And first, here are your closing numbers.
We just put a picture of me when I was like 9 years old on To Tell the Truth.
I have a confession. I am a total ghetto princess. I love rap and hip-hop music and Christian music.
Pardee was kind of a dick yesterday.
I'm very proud of the role that Al Jazeera has played.
You know how sometimes you see a story and it seems so whole and complete, you think you understand it, and then you glimpse something else. You hear or see some other part of it and realize everything you thought you knew, you don't know? I'm Tom Hartman. Welcome to The Big Picture.
What drives the world?
The fear-mongering used by politicians.
Who makes decisions?
Considerable breakthrough has already been made.
Who can you trust?
No one who is imbued with a global missionary zeal.
Where are we heading?
State-controlled capitalism is called fascism.
When nobody dares to ask, we do. RT, question more.
All right, we are back with Reggie Middleton, entrepreneurial investor and independent analyst, to talk about Bank of America. We got into it a little bit before the break. We talked about the credit default swaps, their exposure to the Eurozone debt crisis, and of course their acquisition of Countrywide, which saddled them with all of these foreclosed homes, bad mortgages, and litigation as well. So, Reggie, I want to bring you back into the conversation because you were mentioning before the insolvency of Bank of America. And this is something you've been warning about since 2008. So my question is, why do you think that now is the time that this is going to reach a tipping point, if that's the case and that this is what you're saying?
Because there's just some pressure from all sides of Bank of America. Before the break, we discussed the Countrywide acquisition, the negative purchase, in my opinion, where they paid less than zero for Countrywide. Basically, they had to pay to buy. There's a negative hole. Countrywide created a negative hole in the acquisition. They also purchased Merrill Lynch, which is one of the biggest CDS writers of that particular period. And you can see where that's gotten them now. Of course, if the U.S. banks can somehow wiggle out of credit default event, then the CDS won't get paid out. But it's a catch-22. The last time I was on your show, I made it very clear in a simple term, the only way out of this is debt destruction, where people have to lose significant money to fill the capital hole. And the same still stands. So let's assume that somehow, through some miracle of financial engineering or voluntary pressure, that there is no credit event and the CDS don't get paid out. That means that all of these large banks that have so many hundreds of trillions of dollars of exposure are now not hedged. They're now naked. So Bank of America, Goldman Sachs, Citibank, JP Morgan are now naked because their credit default swaps may or may not get paid because the credit event is decided upon politicians somewhere in Europe and a back room somewhere.
So you're saying
so it's a catch-22.
It's a catch-22 because the credit event is decided upon by politicians regardless of what the market is saying or what the reality is.
Well, that's what the politicians are saying. I've yet to be convinced of that, but I'm just giving you a hypothetical. No matter which way it goes, you know, you don't have a fundamental basis for you know, a 40 or 50 point jump in the S&P 500 in one day.
Right.
Things are not better. They're not even the same. They're worse than they were before.
They're worse than they were before. So you say with this combined pressure on Bank of America, with Countrywide, with Merrill Lynch, with all of this that's going on kind of at a more macro level, are you saying that Bank of America is going to fail in the way that Lehman Brothers did?
Well, I haven't ran the numbers in quite some time because there are bigger fish to catch in the sea, but it's my off-the-cuff opinion that the common equity in Bank of America is either worthless or very close to it. That $6 that you see quoted on your stock screen is gimme, basically, and it shouldn't be there. If you remember other banks that apparently almost died in a flash, we're trading a lot higher than $6. Bear Stearns was trading triple digits just a couple of months before it collapsed. Lehman Brothers was trading at $40 or $50 just a few months before it collapsed. Bank of America has been holding on by a thread. They have had a lot of government assistance, but they also have much larger problems than Lehman from an aggregate perspective. They bought two of the biggest.
A much larger problem.
Yeah, they bought two of the biggest problems in each industry.
Wow. Okay. So much larger problem. You say they're hanging by a thread. If that's the case, why isn't everyone out there saying what you're saying? Why is Warren Buffett giving them $5 billion too?
Well, Warren Buffett is not the average investor. I said the common equity is worthless. Warren Buffett goes in with preferred equity with special liquidation rights, where he gets paid before you would get paid if you go to your E-Trade account and attempt to buy stock. That being said, from what I understand, I wouldn't have bought the preferred either. But, you know, it's Warren Buffett. You know, I don't want to denigrate him. He's a very successful man, but, you know, I definitely do disagree with that purchase. I think there were other better purchases to be made. But, you know, that's what makes a trade. Two sides of every, there's two sides to every trade.
And just quickly, why are you out there saying what other people aren't?
You know, I'm a very honest person. You know, I'm not long only. I go long or short, and I basically say what I see. A lot of the pundits on many of the media outlets are long on the investors, so they talk their book, basically.
All right.
Again, not to denigrate many investors, but, you know, that's the way I see it. Let's put it that way.
And Reggie Middleton, we appreciate you coming on the show and telling us why you think that Bank of America, without all of the other influences that maybe some people that go on TV do have, why you think it's essentially worthless, and why all of this news out of Europe, the news about Countrywide and what still exists there is all bad, and you shouldn't believe that stock price. That was Reggie Middleton in our New York studio. So we have gone over some really heavy stuff. The fall of banks, debt deals. Now let's talk about some more fun financial stuff. So I have Dimitri here, our producer extraordinaire, and also Shannon Donahoe in the control room to talk about Berlusconi. He's always in the news, and the debt deal has and all of these negotiations have given many more opportunities to hear about what he is up to, and new wiretaps that have been released of conversations between Berlusconi and an entrepreneur currently being investigated over allegations that he paid women to sleep with Berlusconi.
That's true. That's what an entrepreneur is. Basically, it's just more allegations coming on a lot of these wiretaps that have been put in part of an investigation for Berlusconi. But I think what's really interesting, do we have that video?
Yeah, quickly we can show, you know, why Berlusconi is so interested in these kind of endeavors. Just watch him check out the Prime Minister of the Danish Prime Minister. Can we watch that? So you can see he walks by and, oh, there he goes, checks her out. Can't miss the opportunity. Let's see it in slow-mo. Okay. Oh, there he goes, checking her out. So no matter how bad his country is crumbling or how bleak the economic outlook is, he does not miss the opportunity to, check out women and sleep with prostitutes?
This is the guy, remember, this is why they love him. He went to Finland years ago. He said that he uses Playboy charm on the prime minister, who was a woman. He said that Angela Merkel is a, quote, lard ass. So basically, he has a real history in this regard. And I think this is the hopes of Europe's debt crisis hinge on what Berlusconi is going to do with Italy. So I think it's an interesting story.
I just wonder if this is a bigger picture reflection of where men's minds just kind of always are, no matter how serious the situations are before
them. That's totally
them.
unfair. That's so unfair.
Okay, well, unfair or not, I said it. And I don't know how fair this is. So there have been a lot of Bernie Madoff auctions over the last few years. But this one is just kind of startling. It doesn't surprise me that people bought his Rolex or some other very valuable items, but someone spent a lot of money on 14 pairs of his boxer shorts. How much money did they spend?
$200.
200 bucks.
Yeah, they bought them at auction. And you know what? I think it went well, because obviously, look, I mean, this is when he was wearing them. He was wearing this is probably during the heyday, you know, when the Cubans were coming over, and there was that whole Coke thing going on in Miami, and this is down at his place in Palm Beach. So, you know, this is when Bernie was shredded. He was looking good. I mean, you know, it makes sense. I understand why they would want that. Look at that. He looks great. This is fantastic. Who wouldn't want those boxers? I would.
They just want to put them on eBay. That's the only reason they bought them, to see if they can get something off of eBay.
Exactly. Any opportunity to make a killing. It's always surprising. I've heard from people that the craziest things do well on eBay. This definitely fits into that category. Speaking of bizarre things that you wouldn't expect, as the world population passes 7 billion, there are calls for us to eat more insects to meet global demand for food. I think we have a clip.
Right, let me try one of these critters. Let's have a look. There we go. So a locust this is, and I must say that's a rather unusual salad ingredient, and I think some people would find the prospect of eating this little chap a bit disgusting, but I'll give it a go. There's a nice crunch.
Is this for real?
So you were asking me if it was for real, and it's for real. On the BBC, they were saying this could be the solution for the global food crisis. We got to expand out. You know, you can't just rely anymore on the traditional staples of human diet that we've been eating and consuming for the past 10,000 years. Now we have to branch out. And what's really great there is you see the guy was eating chocolate-covered scorpions. You know, crickets and all sorts of other beetles and things like that are on the delicacy. Remember Indiana Jones when he was there during the Castle of Doom, wherever that was, he ate beetles. They were
it's disgusting. It's the most disgusting scene, and that was from a London restaurant.
Honestly, this is just gross, and what it comes down to is when we have octomoms, that's bringing the population up. Now we all have to eat bugs.
Yeah, when people are having 8 babies, you have to eat things with 8 legs, and especially as the Agriculture Department is saying that food prices are expected to rise a lot more than they did in 2010.
I think it looks good. I think this looks tasty.
That's all we have time for, Dimitri. So we can't hear about how tasty you think that looks. We'll just have to hear about your experience when you go eat them, because that is it for our show. Thanks so much for watching. Please follow me on Twitter at Lauren Lister and give us feedback on the show at youtube.com/capitalaccount. Be nice, you YouTube commenters. And I am Lauren Lister. Until next time, from everyone here at Capital Account, have a great night.